Well, hello there and welcome to That Investing Podcast, part of Investing Reviews. Today I am joined by Mr. Kirk Bonde, who is one of, if not eToro's best stock analysts with a 25% average annual return since 2013. How are you today, sir?
Very well, thank you. How are you?
I'm doing very well. Well, I say I'm doing very well. I've got a couple of relatively ill children at home today. So not the best day, but that's part and parcel of having children. What have you been up to the last few days?
Yesterday we had a meeting with all the biggest clients of eToro, with me and some of the other top popular investors and eToro CEO.
Mm.
And other than that, most days look a little bit the same. They are analyzing the markets, so it could be one company, another industry, looking at the numbers for this slice of the world or that slice of the world.
Yeah.
And I do spend a lot of time in front of my computer or in Zoom calls.
I think I spend my entire life in front of my computer, and half of my clients are in Australia and the other half are in the UK. So your mind has kind of switched globally, isn't it, between what you're doing? So tell me about your background. Tell me, how did you get involved with eToro?
So I started out my career as a management consultant, so advising some of the largest companies in the world, especially on valuations. So how much is a company really worth?
Yeah.
And then as I was doing that, I was making more money than I was spending. So I wanted to invest my money.
Right.
Then I looked at what my bank had to offer, what my pension fund had to offer, and I was very unimpressed.
Yeah.
They were charging quite high fees for managing some portfolio that I thought were quite poorly constructed.
Indeed.
The Danish pension fund was only investing in Danish companies, Danish corporate bonds, Danish government bonds. I thought, okay, so they're charging a fee for giving me no diversification at all. Okay, I can definitely, having had my degree in finance and working as a consultant, do better than that.
Yeah.
And then I got out a spreadsheet in the same way I would if I was making a decision for a large bank and compared all the different brokers. What are the fees like? What are the different investments available? How good is the app? How good is the website? And so forth. And then overall, eToro came out as number one. And then I started investing on eToro. And then because my investments kept doing very well on eToro, people started copying me.
Indeed.
And then, initially it was sort of fun with a few people copying me, but more and more people started copying me. And then eventually in 2018, I quit consulting to focus only on managing my investment portfolio. And then, a few years later, I was then the most copied popular investor on eToro.
That is a dream story. So you didn't really think that you become the most copied investor when you started out then?
No, it was very sort of a gradual process. There were lots of small. It was fun when the first copier arrived. It was fun when number 10 came, then number 100, then number 1,000, then number 10,000. And maybe one day I'll get to 100,000, but we'll see.
Well, let's hope so. No, if you're number one on the website, I guess it becomes easier to grow much faster when you're on top.
There's a lot of things that synergize.
Yeah.
For sure.
So I've got a few questions for you here. We'll start at the start. So question number one, as I just mentioned, you've made I would say, very impressive average annual return of 25% since 2013. So, a good 10 years. That's nearly double the average S&P 500 annual return over the same time frame. What gives you an edge?
So, firstly, I think just doing valuations is actually a rare skill.
Yeah.
If you go out into a large bank or a large company, very few people actually know how to do valuations. Thus, a lot of consultants and investment bankers are hired to do that. So, a good recommendation for many young people, if you don't know what to do, consider learning to do valuations. It's a highly sought after skill, and you can make money as a consultant, as an investor, or in many other ways with the valuation skills. But then I also have, I'd say my specialty is really at the intersection of finance, politics, and technology. There are a lot of people that know two of those areas well, but there are very few that know all three. And I picked them up sort of not randomly, but because my dad was a politician, I grew up learning a lot about politics. And I thought myself I wanted to be a politician. So I learned a lot about politics. Then because management consulting and my career chose to drag me to finance, I learned a lot about that. And then I guess just for my own passions, they took me into technology. And then I developed a lot of knowledge in those areas, and that's sort of a lot of good, unique investment hypothesis is then thrown off to me from being able to sometimes analyze a company, and then there's something that I pick up between these and someone else that potentially others won't because they're not, maybe they see this, but they don't understand that there's something wrong here. And as one example, you'll often have some technologists that are really good at predicting the future, but they don't understand what anything should cost price-wise. So then they can't make the best investments. You have other people that are very good at finance. They're very good at calculating sort of like, we're going to make that cash flow with that risk at that time, then it should be worth this today, and they can adjust for a lot of stuff. But then they don't know that technology is terrible compared to that other one. or they don't understand that there's like this political risk here or something. So there's a lot of bad investments I can dodge because I understand that that's the part that's wrong here. That's the part that's wrong there.
So what you're saying is that, say, you've got an investment picture and like 90% of it could look great, but there could be 10% of it, which could be like a political angle, for example, and you might know something that other people won't spot. So you have a better macro view of the investing world. Is that a good summary of what you're trying to say?
It's to make the best investments, you're often tasked with comparing some real like apples to oranges kind of stuff.
Yeah.
And you can only do that if you know a lot about a lot of things.
Yes.
And a lot of the stuff where if you only specialize in one thing, that'll have already been picked up by others. If you know a little bit about everything, that'll have been picked up as well. So you sort of, there's the biggest alpha potential sort of come from knowing a lot about a few things. So you got to sort of find that box of like
jack of all trades.
It says like a jack of 3 trades or some jack of 4 trades maybe would be optimal.
So you specialize, but not too specialist. That's an interesting way of looking, but then I suppose it definitely works for you given your return. So let's say you're a new investor, potentially coming onto eToro and you've never invested before. What sort of things should you be doing before you start investing, before you start copying anyone?
So firstly, people should try to, have a think or take down some notes on what they think their own risk profile is like, what they think that their own cash needs are, how much cash they can potentially set aside for investments. If you, for instance, already know that you might need a lot of cash to pay for your children's university down the line, or you're retiring in a few years or something, that puts your risk profile in a different category. It could mean some other products are better than some others. Then if you understand that, okay, you actually do have a lot of cash that's earning a poor interest in the bank, and some of this should potentially be invested in stocks instead, then you can sort of quite easily from there download something like the eToro app and use a demo account and just see how it all works, so that if you're going to misclick and click the sell button instead of the buy button, like you did it with the fictive money before you tried with the real money.
Yeah, the demo account on eToro or just any other platform is just the best thing ever, especially when you're investors, because we've all been there, and a lot of them as well. I think eToro does have some advanced tools, but it is relatively simple. It's quite easy to make a mistake when you're starting out. So your return over the past 2 years is just over 6%, which would underperform, index investing like FTSE 100 or the S&P 500. Is this kind of volatility to be expected? When people are copying you, are you saying you should be copying me for like 5-10 years plus, or is it just part of the market?
Yeah, I always say minimum 5-year horizon. If people already know now that they would need the money for buying a property or kids' university or whatever in less than 5 years, then potentially it's a better risk return offer to just lock the money into a fixed income or structured product for that period, so that you have much less downside. My portfolio is sort of, I've had good and bad years. I expect in the future I will have very good and very bad years as well. It's if I wanted a portfolio with a positive return every year, I would construct a very different portfolio.
Right.
Then it would be something, including just inflation protected government bonds, for instance, logging in a very safe 2% per year. But markets have historically on average delivered 7% per year. And I've delivered way above that. So I wouldn't want to safely get 2%. I have chosen a risk level that I think is medium. It's now a 3. It's usually been between 4 and 5 on the eToro's risk score.
Yes.
So from 1 to 10, the 10 is very bad. And that's a risk level that I think is very good for me and for my family members that copy me, my friends that copy me, and many people in many situations. It doesn't mean taking no risk. It doesn't mean taking maximum risk. It's just that what I call my risk appetite. So that's the level of risk I want to be taking. And I want to have as high potential returns at that risk level. And every day I'm faced with options for, potentially I could reduce my risk a little bit at this thing that I don't think will hurt my profitability too much. Or I could here I can, by just adding a little bit to the risk, I think earn a lot more. So that's always the trade-off.
Yeah. I mean, it's the offer. I'm a very high risk investor, high risk, high reward. So, if I focus more on like the small cap sector, and eToro doesn't really have like the small caps I like to invest in. But obviously that's only going to appeal to a very small number of people. Whereas what you're saying is, if you're going 3 to 5 out of 10 on the eToro risk index, there is some risk, but it's relatively palatable given the rewards involved.
Exactly.
Yeah. So you allocate almost all of your portfolio to stocks. Why not add in more cryptocurrency or commodities? I mean, your portfolio is nearly 99% allocated to stocks, isn't it?
Yes. So I think, so if you look historically, stocks has been the best asset category through any amount of time. Also, if you look before, there were real stock markets, but equity-like investments, whether there was a copper mine in the Roman Empire or sitting out on a Viking voyage or whatever it was, companies or ventures, that's the best category investments. Second to that has historically been property. After that, bonds. They're paying out a lot less now than they used to. A little bit better the past few years, but still not so good by historical standards. Commodities have historically done nothing. The past 20 years, they've been okay, but still worse than stocks. And crypto, I think, overall is not a very good category at all. For me, crypto falls in the category of collectibles. And collectibles have, each collectible has had a time period where it was good. But if you look at collectibles in total, whether that was tulips in the Netherlands back in the day, or stamps, or Pokemon cards, or whatever it is,
very good.
They're on average not a great category. And for commodities, if you had a gold bar during the Roman Empire and you kept that gold bar, today you would still just have that gold bar. Like that gold bar didn't give birth to any little baby gold bars. It didn't found new spin-off gold bars. That gold bar, same if you have a barrel of oil, you continue to have a barrel of oil and you still have that barrel of oil. So that might grow a little bit because of supply and demand and whatnot. But fundamentally, companies can make a profit every year and they can reinvest that in themselves or they can pay it out to you. And that's just a much better proposition. Similarly, if you have a property and you rent that property out and then you use that money to pay the taxes on it and then the interest rate and whatnot, then that can earn a quite good return that you can invest in more properties. And if you owned one property during the Roman Empire and you just kept taking the profits from that risk and more, you would have way, way more today than if you had put it in gold oil. And so that's why it's great to have property, especially the first property people buy is in a unique risk category because it's hedged against your need, for a place, to sleep,
to live. Yes.
And but then after that, certainly like the extra return that has been historically on average for stocks, and I think is if you look at the growth rates and profit margins and sort of long-term potential for a lot of companies, is also I think stocks is definitely the most attractive looking asset class right now. And so if for many people, it makes sense to have stocks.
I completely agree. I mean, you were talking about real estate and housing there. Obviously, real estate is a popular asset class as well. But I would say the liquidity there just isn't there, right? So if you own a house or you're renting out a house to make money, yes, you can generate a profit and sometimes you can beat some popular stocks. Having said that, if there's a housing market downturn, trying to sell, in most Western countries can take a few weeks up to a few months. Whereas with an equity on eToro, you click a button and it's gone. And that kind of liquidity, I mean, it obviously you trying to think of the words, you kind of take it for granted in 2023, but actually that kind of being able to just click a button and change it that quickly, we've never had it before in history, which is just amazing.
And I think about it often when I look at my eToro platform, if I compare like how difficult it was to make an investment 300 years ago, like how many large documents you needed to get signed and how much you had to put into just, to go and invest in one ship leaving London and then that one ship sank and you had lost all your money. Like compared to the ability to just take up your phone and you can invest in so many different companies from around the world with so much good paperwork in order and so forth. Like that is really a luxurious situation that we find ourselves in.
It's a double-edged sword though, isn't it? I invest over the long term as well. And because it's so easy to buy and sell, I think there's lots of people who should be investing over the long term, but because they can just click buy and sell, they trade too regularly. And then they just end up losing money, which is the flip side of that. So speaking of which, your eToro stats, which I'm pretty confident are accurate, you place roughly 3.4 trades per week, and you have a holding time of over 2 years on average. These 3.4 trades, is it mostly just adding to current positions?
No, it's not just adding to new positions. There's of course, I receive a few dividends from some of the companies, so those will have to be reinvested. They can be invested into some of the same companies, or they can be invested in new companies. But as often, if I'm getting rid of a stock, I'll be investing it in some other stock. And sometimes I'll be reducing my position in one stock to increase it a little bit in another one. But it's not like that I just stick with the same stock. When I buy a stock, it's always with a holding time of forever in mind. But then as the world changes, as specs change, as prices change, there often is the case that the worst or the least attractive asset that I've invested in is always at risk of being replaced by the most attractive asset I haven't invested in yet, or one of the other ones I already like and want more of.
Yeah, well, I mean, if you look at the indices like the S&P 500 or the FTSE 100, I think the FTSE, there's only 12 of the original companies are left in the index from when it was founded. So obviously you have to chop and change. I mean, it's say you wanted to get started copying your portfolio, how easy is that to do on eToro? Is that a pretty simple thing? And do you think there are investors who, what kind of investors would it appeal to? Are there any investors who you think should stay away from copying you? And conversely, there's got to be many that, you think are definitely kind of match well with your portfolio?
So, I mean, eToro has users in over 100 different countries. Historically, it's been focused a lot on retail investors, but there's a lot more, much richer clients coming in now as well.
Yeah.
And in terms of who shouldn't copy me, I already mentioned if you know that you will need the money for a fixed expense within the next 5 years, then in all likelihood, this is like stocks is not the right investment category, and I'm more than 90% invested in stocks, so that's not a good match.
Yeah.
There are other people that are much more risk-seeking. I don't condone that, saying like people that just want to come in and only buy Bitcoin or only buy, and that's sort of like if they copy me, they'll probably just be sad after 1 year that they didn't focus on the risk thing or whatever. So they might as well not start, you could say.
Yeah.
But I'm not condoning then what they're going to do instead. Often, you see, I can look at I look at other people's portfolio on eToro as well, and sometimes I see a portfolio, I think, very sensible. This will do well in the long run. Other times I see one is like, yeah, this guy will be out of his money in a few years with this kind of investments.
It's interesting, isn't it? Because obviously one of the pitfalls, I would say, of copy trading is that you can go, right, this investor made a 300% return over 1 year, for example. But then you could invest with them and then next year and they lose 95% because those kind of returns often aren't sustainable. What would you say is your strongest conviction investment at the moment? As some of your largest holdings, you've got TSMC, so Taiwan Semiconductor, you've got Meta, Facebook, WhatsApp, Instagram owner, you've got Microsoft. Would you say, if there's is there a stock in your portfolio that if you had to hold for the next 50 years, what would it be?
Then the returns and the risks, they come up with a very safe one that you could say is a high conviction one that I think 50 years from now will still be a great, with one like Host Hotels and Resorts, because they don't have much debt and they own some very amazing luxury hotels around the world, mainly in the US. And these are very good. Hypothetically, if nobody ever wanted to go to a hotel anymore, they could just say, okay, all shareholders, you just get one room each. Now you have the so that's very, very safe because it's just backed by all this amazing real estate. So that's a very sort of safe one in that case. But then the other companies like UBS, they are a really, really great financial institution that has really, really cornered the market for the very richest clients, offering a complete unique proposition that others simply can't replicate. They completely demolished the competition. The smartest people were always leaving Credit Suisse to go to UBS. And they are, if compared to how much you're paying for that one, it just seems like an incredibly good deal you're getting on that particular stock. But of course, then, the financial service industry could become completely disrupted by the technology industry over a few years. Some companies, in the financial services space could save a lot of money by using new AI tools. But if then it's just not them doing it, someone else doing it, then, then you can quickly lose out on it. But when you I like to also have some companies in the portfolio that I think are, when I first invested in Tesla in 2016, I didn't think that they were the safest stock, but I thought that it's a company that was very cheap compared for it having a likelihood of being the most valuable company in the world one day. And then I had a high conviction that was worth paying that price for. And, but I'm okay having 9 out of 10 scenarios, this doesn't work out. But the one where it does, my God, this is going to be amazing. And then, I just average them out and say, as long as I have a portfolio that's good across many scenarios, okay, if there's a war here, I lose on this, but again, on my defense stocks. Or if this thing happens over here, this one's demolished, but then actually these ones win, then I can sort of get to a state of peace of mind where I know, whatever happens, I'm okay.
Whatever happens, I'm okay. Well, I guess that's why you've got sort of 60-ish, I think 60 holdings in your portfolio. So there's no chance that one company just has a terrible day. It's not going to hit you too hard. So I guess, you get a good night's sleep. It's funny that you mentioned Tesla, because I wasn't sure that Tesla was going to do well. I did think that electric vehicles was going to be a big mega trend. And I invested in a lot of small cap lithium explorers in Australia a few years ago. And those obviously did really well. In past interviews, you've talked about mega trends. So one of, obviously in 2023, the mega trend is AI. But if you're an average investor, how can you see the next, or even you, how can you see the next mega trend? When you talk about planes or iPhones or cars or even the internet itself, when they were first introduced to the world, a lot of people just laughed at the concepts and said they'd never take off. So how can you know where the next mega trend is going to come from?
I think there are two sort of sources. One is just all the smartest people in the world all thinking about the same things all the time. And and other people are just like, says a few months ago, it was LK99. Now, most people in the world don't know what that is, but all the smartest people in the world were only focusing on this one thing for like a little short period of time.
Yeah.
So that's like sort of one source. Then you can often also just extrapolate what the best places in the world are doing or the best companies are doing, and then think that others will do the same thing in that particular category. So if you're looking like, okay, my home country of Denmark and Copenhagen, we are very good at, maybe sustainability and how to run the government and so forth. So maybe other countries will do what we do later. In San Francisco, they're ahead on technology. So maybe what they are doing in terms of technology, others will do later. In London, we're maybe better at financial services. And then you just you can just a little bit extrapolate sometimes that whatever the rich people are doing now, the poor people will eventually be doing. Whatever the smartest people are doing now, the dumbest people will eventually be doing. Whatever the coolest people are doing over here, eventually the uncool people will be doing. And so we then when you add those things together, you can sometimes then spot something like, wait, if they do this, they do this, and this, then it's going to become like this. And then that at least for me, time and time again, just turns out to be to then be an accurate prediction of the future.
So you fit all the smartest people, all the biggest companies, they're all going after the next trend, and that's what you're kind of tracking. You mentioned LK99. That's the I didn't follow it closely. It was the room temperature superconductor.
Yeah, exactly.
Did they? It failed. As far as I'm aware, it failed, didn't it?
It did.
Yeah, and that's. I guess that's the trouble, isn't it? Whenever you're looking for like the next big thing, I mentioned the internet or the iPhone, and there's when Bill Gates was talking about the internet or Letterman or various CEOs of companies were kind of laughing at the iPhone when it came out and said it wouldn't work out. 99% of the time, these things you think might become mega trends don't happen, do they? And it's only that 1% of the time when you're right. And then obviously that's part of the game. That's what a lot of investing is, research that you do into things that don't work out.
But yeah, that's that. I mean, I'll analyze a company, and then after a long time thinking this is good, I come across them like, wait a minute, actually this is bad because of this thing. Okay,
yeah,
that research isn't down the drain, but that's then now look at something else. Okay, and you go through that, and then after many times of doing that, you hit upon something where like, wait a minute, where's the downside here? There's no downside here. This is a good one. Okay.
Yes. No, but for every sort of, I don't know, I guess for me, for every kind of 7 companies I do intense research into, only one gets invested into. And I guess if you've got sort of 60 companies in your portfolio, I guess that's a lot of research for you to be doing by yourself. On a daily, yearly basis. Would you say that's a fair comment?
Yeah, I have my assistant as well. I used to have 5 assistants, but now sort of automated most things. And there are a lot of great tools you can use to sort of like, so everything that can be automated is automated, but there's a lot of stuff where you have to yourself read the report. You have to yourself dig into it. It's not enough that you trust some expert on it. You have to
do it yourself.
Look at the experiment yourself, go through the science yourself, so that you build up that understanding so that you can then like really get what's going on with something. And I found there's also good ways to how to learn quicker. How to just get to the right insights faster in different topics, but it is all I do as well. I spend my entire life just doing research, learning, doing more research, learning, and then consolidating that and giving a presentation about it, or in this case, using it to make an investment. So that's and I love it. I could do it a million years and not get bored.
Yeah, so could I. I mean, the primary sources thing is the classic. If you look at, like, say, Tesla releases like a quarterly earnings report, right? Every different newspaper will have a different headline, and at one will be like, oh, they sold more cars, or they've made more cars, or they've got higher revenue, they've got reducing profits, their margins are dipping, something about China. You actually have to read it yourself and listen in on the earnings call to actually understand what's going on before you let other people's opinions color yours. So here's a question for you. You focus on fundamentals like me. Are you not a fan of technical analysis? Do you use it at all, or not?
No, I'm not just that. I hate it. I think it's absolute. And I think it's a very sad state that there are so many people who go on YouTube and then they type in, learn about investing. And then 2 days later, they are now less smart than when they started. If you go and you just type in a stock name in Google, it's going to immediately show you a historical price chart and all sorts of useless junk about what was the trading volume and what was the, change in price yesterday and stuff that really should not be relevant to anybody anywhere. But that's what's being pushed. And so, if you want to learn about investments, you basically have to go to a good university and learn there, because otherwise there's just too high risk that you'll start out with some bad information, and then that'll just lead you to get more bad information, and now you'll have a full deep level in understanding in something that's equivalent to astrology or some other genre.
I would say I just like the chart patterns and all of it. I just, like when I'm picking companies, and we'll have different metrics, I guess, but the idea that sort of because a line went a different way last week, the month before, it'll go up or down tomorrow or the week after is ludicrous to me. And if technical analysis was so accurate, you would assume that the technical analysts would all be millionaires and retired by now. But they're not. They're working year after year, so there's got to be a reason why.
Exactly.
I guess my view on it. So you focus on the fundamentals, but do you ever let a qualitative factor affect your fundamental approach? So, for example, would you have a gut feeling, or you like the CEO, or it's not something specifically about the numbers or about the tech? Do you ever invest based on that, or does it have to be kind of strictly rooted in the numbers and in the technology?
I mean, so many years ago, I read a list of 163 different cognitive biases, and I've very meticulously tried to root them all out. So, I wouldn't have a big spring like, oh, now I'm hungry and I'm making a bad decision because I'm hungry or something. I use my financial models. I believe that if you just like go on your gut feeling, that'll give you one level of decision. If you write down everything you think about it, if you then research it carefully, if you then get other people's input on it, and then you build up a big framework and structure it well, and assign how important is that factor, how important is that factor. Yeah. Then when you add all that up, you just on average get way better decisions.
Of course.
The large bank is going to make a very, very big decision. They like to bring in some consultants to, talk to everybody, make such a big framework, weigh all the factors so that if it's a bad decision, at least you can explain extremely accurately why that decision was made. Like, here is all of the things that were considered as part of this decision. And in that process of doing that, I think sort of how I feel on that given day or something like that is quite weeded out. Then in terms of making the qualitative versus the numerical, I think I like to take the qualitative and make it numerical. So if someone says to me like, ooh, I would love a pizza, but I really fancy sushi. Now it's difficult for me to, because like I need to place an order. Like, am I going to invest more in the sushi or the pizza? What are we getting for takeaway here? So I need to say, okay, well, this one gets a 9 and this one gets a 7. So we're going to buy the 9. And you can break it further down and say like, well, this one's healthier, this one's cheaper, this one has more calories, this one comes fast, this one has a better. Then you can break all of that down, and then you can get a much more accurate explanation of what you. So if I just say I love it, okay, great. But if you break that into like 12 subcomponents and you have really carefully weighted them and seen what the synergies are between them, then you're giving me a much more accurate explanation of which one you prefer. And so you take the.
It's problematic though, isn't it? Because if you're investing in kind of like maybe early stage tech, sometimes I know most of your companies are blue chip, but say a room temperature superconductor where you're not sure if it's going to work or not. Obviously, this could be a company that doesn't have much revenue, but it might have an amazing product, but you're not 100% sure. How do you analyze that? How do you break that down into numbers? Or do you just stay away from those kind of investments?
So I definitely do not stay away from that at all. I think that is one of the hardest things for investors. At least it's not hard for me, but it's hard for many people to quantify the sort of like fuzzy stuff. So you have something, people like to say, well, last quarter the revenue was this, because that's a fact. You can't dispute it. So it's very comfortable to work with that. But it's like 30 years from now, are we going to have teleportation? Like, no, but is the percentage like 0.0001%? Okay, then we can discard it sort of. But taking something like, are we going to have a world war? What is the percentage likelihood of that? That's a lot of people shy away from those questions, and then they end up with worse investments because they haven't assigned percentages to things that are really important, even though we can't like say exactly, what something about it is.
Indeed.
And it's super important for a good valuation to take all the most important stuff that's really fuzzy and really difficult to quantify, and then come with your best number for it. And then say like, maybe you don't know if it's 20% or 50%, but you're going to say that 32 is better than 33 for your guess. And then if you do that again and again and again, on average, you'll then be more right. It's something you just got to like force yourself to do, to take and be willing to put some numbers on some things that are not
easy to put numbers on, maybe.
Yeah.
So, I mean, those kind of smaller companies, eToro's got, I think, like 3,000 asset classes you can invest in. Correct me if I'm wrong. So are there ever companies that you want to invest in, but that you can't find on the platform?
Yes, and then I tell eToro about them, and then sometimes they're nice to add them to the platform. There's also sometimes some stocks that are too small, because when I invest with 25,000 people copying, it can be quite a volume. So eToro sets some limits on what kind of liquidity there must be in place. So if this is a very small company and I want to buy a big stake, then it would simply cause the price to spike too much, and then the eToro sort of won't allow that.
I guess you don't want to be accused of you can inadvertently manipulate the market. I guess if you have that many people following you and it's a micro cap company and you buy the shares and they all buy, then when you sell,
it's the same order, so it's not like my order is carried out beforehand.
No, it's all at the same time, isn't it? The point I'm trying to make is that, say you have a £20 million company and you and thousands of other invest at the same time, that can shoot up the share price. If you then all sell at the same time, which obviously you will, that can drop it as well. So I guess it makes sense that you've got a limit to how small a company can be. In terms of leverage, I'm guessing if you're not a fan of technical analysis, I'm guessing you're also not a fan of leverage, and neither am I. But I'm going to ask the question anyway. So if you're a UK-based investor, you can get some serious tax advantages using an ISA. But given that you've had a 25% average annual return, for people with sufficient liquidity, shouldn't they just be trading on leverage using your portfolio? Would they not just massively increase their profits?
So I think so. So firstly, in terms of leverage, I don't use leverage, and I generally don't think it's a good idea to use leverage. When you're using leverage, you're effectively borrowing money to invest. If you want to borrow money to invest, you should think about how you can borrow money the cheapest. For many people, that would mean like remortgaging your house, for instance, not just going in and gearing on any particular platform. Then in terms of an ISA, that's a great product as well, and the tax advantages are not to be discounted at all. And my investments on eToro there have done more than well enough to sort of compensate for any kind of other factor there would have been. But it's depending on where people live and whatnot, there are different things to consider.
So you seem very bullish on stocks as an asset class, and for good reason. You were talking about like getting return on bonds of about 2% historically. In the UK, there's a National Savings and Investment Account, which is government-backed. You get a 6.2% guaranteed annual return at the moment. Given that the world, the Western world anyway, arguably is about to tip into recession, why would you invest in stocks when you could get a 6.2% guaranteed return over the next year, and then after that start investing when the recovery comes?
Yeah, it's all about inflation risk, effectively.
Right.
If you had all your money invested in bonds and cash, and you lived in Germany in the 20s, you would have nothing left, right? All of it would have been wiped out. Like, this bank owes you this many Reichsmark, this bank owes you this many Reichsmark, and Reichsmark are now worth nothing. That's the core problem with normal bonds and cash, is that if there's a lot of inflation, their value is destroyed. And so if you're earning 6.2%, but the inflation is 3%, then there's only 3% point something left to you, and that's
not great.
Then a lot of companies, and it also goes for properties, are able to sort of offset that. So if there's a high inflation, they can also increase their prices, and then you sort of get rid of that inflation risk to an extent. Some can sometimes even benefit from it. And then if you look at sort of 6.2% minus the inflation, your real return of then about potentially 3% is still a lot lower than the historical average of 7% the stocks have yielded, or 10% including inflation. So if you look at sort of 3% per year, that'll take you 24 years to double your money, but 7% per year, that'll take you 10 years to double your money. So if you do that for imagine that you do it, your son does it, and then your grandchildren do it for, you keep doubling it every 10 years. After some decades, it can go really, really wild. But if you're instead doubling every 24 years, then the family fortune just doesn't grow at the same pace.
The joys of compound returns, best thing in the world.
It certainly is.
I've got one more question for you, and this has been a really interesting conversation. What's the best book for first-time investors to read? Do you have books on your shelf, or are you past the kind of reading stage?
I read about...
Are you ever past the reading stage?
No, I read about 30 books per year. I love reading. I think it's my favorite genre is biographies. So if there's some biography, then it'll go on the list of biographies that I'm gonna read. And I don't know what is the best book for, the classic is the Benjamin Graham's book, The Intelligent Investor, but it's very old by now. So I would assume that someone must have written a better beginner's book about investments. But I guess I'm not really that keen on spending my time on reading a beginner's book on investments.
I know you're way past it.
I don't know which one is actually the best nowadays.
That's fair. I mean, honestly, we're doing an Investing Reviews podcast, and a lot of this is, for, people who are kind of newer to investing and trying to find like a decent platform, kind of like you were many years ago when you decided you settled on eToro. But yeah, I mean, are you planning on staying with eToro pretty much forever now? Doing this forever until your hairs are grey and retiring?
Yeah, so I mean, the goal for a long time was to be number one in eToro. So now the goal is to have a higher lifetime return than Warren Buffett. So we'll see if, and he's still going strong at age 90 something. So maybe we'll see. Maybe I can't stay sharp
and beat him
all that long, but. Yeah, we'll see.
Well, maybe you'll be the one writing the book that everybody wants to read in 10, 20, 30 years from now. Who knows?
I don't think so. I think I decided maybe I could be a great teacher. Maybe I could write a good book. There are so many things I could potentially do, but I'm just going to focus only on managing my investment portfolio and then not like have a plan B or some other side project or something.
Excellent. Right. Wonderful. Well, that was really great conversation to have with you. And I would really love to have you back on the podcast at some point in the future.
Yeah, definitely.
That was That Investing Podcast, and we will see you in another couple of weeks.
Thank you for listening to That Investing Podcast, brought to you by the team at Investing Reviews. Check out our latest stock market news and analysis at investingreviews.co.uk. You can also find us on Twitter and LinkedIn. Just search for Investing Reviews.